How did you underwrite getting them to adopt to this technology and to show them tangible efficiency and outcomes that would benefit them in the long run?
The first thing I say to them is, I actually don't care if you invest with us or not. What I'd love is a relationship with your ops team so that we can use your real estate to help our portfolio companies.
Well, listen, I'd like to welcome everybody to our Counting Capital podcast. I'm very excited about our guest today. I'm Robert Brunswick, chairman of Buchanan Street Partners, and it's a pleasure for me to have Jeff Berman join us. Jeff is going to really talk to us and educate us about property technology, otherwise known as prop tech, and it's kind of merging with the real estate space. So lots to learn there. I kind of frame it as real estate meets venture capital, and we'll talk more about that. Jeff started a company called Camber Creek. We're going to dive into what Camber Creek does today, how they invest, how they see opportunity. Prior to Camber Creek, he was a principal at one of Washington, D.C.'s largest real estate development and management companies. So he's steeped in a real estate background, but we're going to understand a little bit about AI and venture investing and the ability of real estate entrepreneurs to accept this new world that they're part of now. So welcome, Jeff. Great to have you on. And I think maybe the best thing to do is have them to get to know you a little bit. So maybe you can describe a bit about your background, kind of your expertise, strengths, aptitudes, just so we can get to know you a little bit.
Absolutely. And there's a lot there. First of all, thank you very much for having me. I'm excited to be here. You mentioned prop tech, property technology. So right at the start, I'd like to reframe that a little bit because that's a term that I don't really use. And the reason being, and this is somewhat nuanced, but we like to say that we invest in real estate technology. And you might ask, well, what's the difference? Real estate technology and prop tech. Real estate technology encompasses all of different types of technology that can be utilized within the built world. So that would be prop tech, con tech, construction tech, retail tech, fintech, this is an important one, etc. Whereas when people say, oh, they're prop tech investors, they sometimes inadvertently pigeonhole the investor into a box that they don't necessarily fit in, which is why the semantics of it is important to me. But as far as my background, so I grew up in the DC area, and my cousin and I were actually the founders. My cousin really was the driving force behind Camber Creek. We were both third generation members of our family office operating business, which was real estate development, ownership, and management. And in 2008, when the real estate world was crumbling, he and I were both still working with a family firm. I was primarily in acquisitions, dispositions, and leasing, and he was the president of operations. And one of the things that we noticed was that we were managing a portfolio that had legacy assets coming from the 50s, early part of the 20th century, and so on. And we're acquiring property all over the country because of the distress that we saw in the environment. At the same time, we're like, wait a minute, we're still managing these properties like Grandpa did. This doesn't make any sense. Surely there are some elements of technology that we can utilize for our business. Well, you have to remember, back in 2007 and 2008, this ubiquitous piece of technology that we all rely on now, it just had come out. This idea of like carrying a supercomputer in your pocket that did everything was not a thing. And technology in real estate really meant your cell phone, your computer, your fax machine, and your computer, like the basic functionality of it. It wasn't really anything greater than that. There certainly was no ecosystem of technology sharing that is now ubiquitous. And so Casey was really the one that said, maybe we should look at developing contacts in this technology ecosystem. And that morphed into, I'm going to make a very long story very short. That morphed into our realizing that this was the greatest wealth generation opportunity of our lifetimes, which was the digitization of the largest asset class on the planet. And we said to our family, hey, we have this idea and we're gonna go. And so we created Camber Creek with their blessing. They're actually investors, of course, but as of now, we're raising our fifth fund, and we've got 300 plus real estate owners and operators around the globe that own billions of square feet of commercial office, retail, multifamily, hospitality, industrial, every type of real estate food group. So that's the background.
So helpful. You unpacked a lot of stuff there. First of all, thank you for the framing of real estate tech. So just for a fun fact, as we get to know you a little bit more, and then we're going to dive into the details. I was checking you out on LinkedIn, and I go, helicopter pilot and wine enthusiast. So, and I said,
Not at the same time.
thank you for that. Perfect for the real estate industry. So you know how to entertain clients, and at the same time, you can do site inspections through the helicopter. So tell me a little bit.
So you know what? The reason I became a helicopter pilot actually goes back to the last real estate deal I did with my family before leaving into Camber Creek. We owned this really large lifestyle shopping center in Palm Beach Gardens, Florida, called Downtown at the Gardens. And it was massive. It was built for 150 million, sold to CalPERS for $250 million. We bought it for 38 million and change. This was during the crisis. It was a phenomenal buy. And a buddy of mine was a helicopter pilot. And I said to him, hey, can you take me up so I can take some aerials? And we go up there, doors off on this Robinson, on this R-44. And the adrenaline, and I'd been in a helicopter before, but I'd never been right seat, essentially like a pilot seat, and with doors off, basically hanging out of this thing. And I'm thinking to myself, the maneuverability was unreal. And I caught the bug. My father and my younger brother are both fixed wing pilots for recreation. And I remember when I was 10 years old, my dad took me up on one of his flights, and he goes, how was that? And I said, Dad, that was super cool. But you know what would be cooler? If you could fly a helicopter. And so that always stuck with me. So I learned how to fly a helicopter. And I will tell you this, it's the coolest thing I've ever done every single time I do it. It's not so practical, but it's an amazing feat of dexterity that you have to employ every time that you're in it. You have to have 100% focus. Maybe not now, because some of the newer models have autopilot, which is unreal and pretty cool to use. But when you learn, especially, you're essentially learning on a lawnmower with a rotor on top of it. It's pretty crazy.
Well, I enjoy it because I had a chance. I used to lifeguard in Laguna Beach, and one of my buddies became a LA County Sheriff helicopter pilot. So he took me on a ride along, and we actually found a bad guy, and he had to circle for 45 minutes during my particular ride along, and he had to keep circling in the same pattern. And at some point, I'm sitting in the back. I said, "You got to turn this thing around and go the other way." He says, "I can't. We'll lose sight of the bad guy."
Well, there are a few things there. So first of all, I was going to ask you, were you sitting in the front or were you sitting in the back? So
Yeah.
That was probably a regulation. Do you remember the equipment you were flying?
No, I don't. But it was a wonder. I mean, it was top end stuff. I can assure you there.
But there's also the issue of wind. And you always want to be going into the wind and staying in trim. And so you think about the concentration that he had to have. He's got this big light, right? That he's on this guy. He's also maneuvering. He's controlling with every digital input on his body. It's pretty awesome stuff.
Well, I won't get into why now, but I am going to send you a thank you bottle that I think you'll enjoy. So you and I can on a separate chapter get into that. But I think what you've shared is great background and a sense of aptitude, the helicopter side, the attentiveness to detail, and just paying attention to lots of things going on at the same time, which I think we all see in the investment space. So now I'd love if you could give our listenership a bit of a primer about just real estate tech and what it includes, what it doesn't include. We're going to get into Camber Creek in a minute and some of your funds, but kind of a simple primer so we can really put it in the box as for your conversation.
Well, let me ask you a question first. If you had to guess about the exposure to real estate that this crowd has, would it tilt more to multifamily, commercial office? Because I can give a specific example that will illuminate.
My, my guess, given the broad nature of our listenership, I'd go to multifamily, but I think all food groups get represented by what we do. But let's go to
Well, let's use
multifamily.
multifamily. So starting at 30,000 feet, this idea of real estate technology and the application to real estate is how can we make our real assets more efficient? How can we create value, lower expenses, raise NOI, right? That's what we think about as real estate people. So we invest in products, software, or services that do just that. So as an example, let's take rent. Rent's pretty important, right? You have this very specific ceremony of a renter pays their rent on the first of the month. They get to stay that month. They have a year lease. Everything works. But what if you have people in your tenancy, let's say more in Class B and Class C buildings, that might live paycheck to paycheck, and they have to avail themselves of different funding sources in order to make their largest expense on that first of the month? Well, as a landlord, that shouldn't be your problem, except for the fact that you also may have debt service. And so you care about getting that rent in on the first of the month. But then you also think to yourself, if you have a larger portfolio, let's say 2,000, 5,000, 10,000, 20,000 units, imagine going through the complicated nature of every single resident that might need some assistance. It's painful. This is where technology steps in. So in our third fund, we actually helped incubate this company, a company called Flex. And what Flex does is very simple. It allows the resident to flex their rent over the course of the month while getting the landlord their money on the first of the month. And they do this in a completely frictionless way with technology. People can sign up right on their phone. The landlords don't even have to be aware that it's in their system because it integrates directly with their property management services. So now, as an example, that company has a TAM of 50-something million units of multifamily in this country. So its ability to grow into a very large company, which now it is fairly obvious to a group like ours. So when you think from a user standpoint, from a landlord standpoint, well, hey, I get my rent on the first of the month. I have a happy resident. I have a financially healthy resident, and I can stick to doing what I do best, which is managing my buildings. Does that make sense?
It does. Yes, helpful. So I want to switch your headset to thinking as a fund manager now, a real estate investment manager. Investors give you money. So we're going to make up numbers. Your first fund was 50 million with a vision of making $22.5 million investments. So I did some early investing in search funds where you'd make a little bet on a investment, knowing that you have follow-on capital that you can then further your investment, knowing that the various rounds of investing for these early stage technologies might need additional financial support, and you want to make sure you're there for that. So frame a little bit of fun for you, how many investments you make, what's the average size of investment, and is this the one where you make 20 investments, 5 are going to hit it out of the park, 10 are going to basically get your money back, and 5 you're going to lose your money? Just frame that a little bit for us.
This is a great question. I love this question. It helps to define our investment thesis. So let me do that first, and then I can answer that question. So our investment thesis is very simple. We ask ourselves 2 questions. The first is, can we use this product, software, service within our portfolio matrix, which we define as the buildings that our limited partners own, the tenants, residents, and guests who work, live, and stay in those buildings, and the vendors who serve all 3. So now as of Fund 5, we have billions of square feet. So if you think about that permutationally, it's millions of potential relationships that can be leveraged both for the portfolio companies and for the limited partners. Now, the second question, this is the more important question because we are a fiduciary. And that is there the potential with this investment to make a venture return commensurate with the risk we are taking at the stage we are taking it? In English, is there the opportunity to make a lot of money. So if you look at our website, you'll notice we've only done 50 some odd deals in 15 years. Now, why is that? Because the vast majority of the companies that we look at satisfy the first question. We can use them in the portfolio matrix. I bet that every company that we look at of quality could be used in your audience's real estate. However, the vast minority actually have the ability to drive a venture return such that we're going to make a lot of money, because I eat from carried interest, right? So I need to make sure these things return a lot of capital. So now to your question about portfolio construction strategy. We tend to invest in 10 to 15 companies per fund. Our fund sizes are between 225 and 325 million. So that's a lot of concentration in relatively few companies. When you dig a level deeper, what has happened over the last 4 funds, we just started deploying out of 5, is that 3 to 4 companies are going to have 60 some odd percent of the capital, and the remainder will have the rest of the capital. Now, what does that look like as far as the return expectation? So this is where that investment thesis that I just explained is so important, because every company we look at goes through this beta lab. We can't just throw spaghetti at the wall and say, this is a bet here, it's a bet there. In fact, we don't use that nomenclature, because we try to make informed investment decisions such that if one of our companies is in trouble, that it has a soft landing. Because if you're in your real estate organization, you're using one of our companies and it goes bankrupt, you're going to care a lot more about the change management and pulling all that out than you care about the investment dollars that you lost. That's just the nature of the beast. And so because we're dealing with massive real estate organizations, some of whom are publicly traded companies, we have to be very careful about where we point that money arrow. And that even if the company doesn't work out, the product, software, service would end up remaining viable even after the company's death. And so as it's worked out in the past, 3 to 4 companies end up becoming the fund returner candidates. 2 to 3 companies become doubles and triples, and the rest are either losses or singles. And that's okay. Our loss ratio for some of our institutional partners, our loss ratio is still a little low, which implies that we don't take enough risk. But at the same time, because of the type of people that we're investing towards, like we have money from all sorts of sources. We have institutional capital, the endowments, pension funds, et cetera. But it's our strategic owners and operators that form the underpinning of what we do. We have to make sure that we're not putting them in any kind of danger as far as the operations of their real estate.
One thing I want to clarify is, of the dollar, of the 100% dollar, how much of those of your investors come from owners and operators of real estate? Because I want to make sure I'm getting clear on that.
Yeah, it's about 60% of our dollars are from owners and operators of real estate. So it's 300 plus groups that own and operate real estate around the globe,
which is predominantly high net worth and family office for the most part, versus an institution, because that would be, you'd have to go through that institution's investment manager. But clarify
both.
That for me.
It's actually both. So because we have publicly traded companies, we have institutional real estate investors, and we also have the ultra high net worths. It's an interesting point you make, though, because when we started raising money, external money, the groups that we went after first were the ultra high net worth owners and operators, because even if they had large companies, the decision rested primarily with them or a small group of people. And so if you think about the innovation curve, right, you have your early adopters and your laggards. Where do you think the institutions are gonna be? They're gonna be on the laggard side almost by definition. It's going to be the owners and operators that own 1,000, 5,000, 10,000, 30,000 units. We have some big players that you've never heard of, but that own hundreds of millions or billions of dollars worth of real estate that are interested in the strategy.
So simply said, give us 5, 6, 7 categories of technology slash services that your investments might support, that would be interesting for our listenership to hear about, that might cover more than multi, When I got in the business, Jeff, there were 4 food groups: retail, office, industrial, multis. Today, there's 25 food groups of sorts in real estate. It's a much more diverse asset class base. So, example for us where you're making an impact.
I would say it's primarily on commercial office, retail, and multifamily. And the reason being shouldn't be that shocking. They're the largest and most established of the food groups, as you said. You go back to the second question in our investment thesis, which is about the venture return, right? If we're going to be able to create a venture return, that means that we need a very large network or cohort of users to onboard these technology companies, which then means the sector of real estate needs to be more mature. And that tends to be in the commercial office and multifamily. So on the commercial office side, as an example, one of our earliest investments is in a company called VTS, which is now a $1 billion plus company. They did something, their steady state product essentially is a portfolio visualization tool, such that if you own millions of square feet, you can dive into the most minute detail on the tiniest suite in your most obscure building in seconds. That's tremendously valuable when you're a large asset manager. It means that your data is right at your fingertips. You can understand your portfolio at a granular level without having to be bombed with reams of paper.
Great. Well, helpful. I think as we look at our next question and helping our listenership kind of understand it, and I'll ask that you'll stay within your compliance border that you certainly know about as a money manager, investment manager. But I'm curious if you could take kind of one example from its inception to its path of activity to its ultimate realization to help us understand how might that have looked from a risk return. Are you playing for 3X's, 2X's? Just there's no cash flow, I assume, through most of this stuff. How does that kind of come through the daisy chain?
Correct. So venture investments tend to be 7 to 10 year. Well, it's a 10-year fund commitment, but 7 to 10-year time horizons. And companies now, because of the public markets, are tending to stay private for longer, which means that liquidity is slower to come by in the private markets than had traditionally been in the past. So I can give, off the top of my head, I'll give an example. I'll give 2 examples actually. Both are in multi, and I tend to really enjoy multi. And I'm just going to go on a slight tangent if you don't mind. Part of the reason why I love multi is that if you think about the sector and large owners and operators, right? The relationship that they had with their tenants and residents was basically, hey, you pay me and you get to stay here. But because of technology now, you get to know your residents at a more granular level. You can serve them more features, which can earn you more money. So as an example of that, in our second fund, we invested in a company called Pet Screening. And so now let me ask you, why did you laugh at that?
Well, because we own apartments. And one of the things that I found very interesting is if you want to have a dog at one of our apartment properties, you'd have to test the dog's feces to make sure that if you left your dog's
excrement,
right, then we could determine who did that and charge them for leaving their dog excrement if we had to pick it up. So I don't know if you were going down that road. Very scientific and effective. Everybody picked up after their dog. They didn't want to be charged $40 to $50.
Actually, that is a great example of technology allowing you to actually create another revenue stream, but hopefully one that was short-lived, because this was a little different. So Pet Screening essentially takes the management of pets, whether it's just a regular pet or a service dog, out of the landlord's hands in a HIPAA compliant way. And we were their seed investor. It was not a large investment, unfortunately, and I'll tell you why in a moment, but it was out of our second fund, which was a tiny fund. That was a $30 million fund. And that investment was made, I think, 5+ years ago. The company just did a large Series B that we were able to monetize 83% of our holdings. We still own 17% at a 20x multiple. So a pretty darn good return. Why did that occur? Because what happened was in our limited partner base, we have about 1 million multifamily units that are represented. And we're able to make these introductions and not hand-holding necessarily, but helping them through the implementation process such that it becomes a no-brainer for the portfolio company and for the limited partner that owns and operates real estate, where they're able to skip to the front of the line. Also, that's a big help when you have hotter technology companies that are capacity constrained. And they grew so quickly, private equity took notice. And so this company grew from very little in ARR, annual recurring revenue, to a pretty large ARR number. Again, I can't give specific numbers. And when they did their latest round, they had so much interest that they said to their earlier investors, hey, do you guys want to cash out? And again, ordinarily, I would say, no, I'd rather hold. It's a 10-year fund. But we were able to give this return basically half our fund, which is a massive number, and we still own 17%. That's when it works out really well. In Fund 3, Flex is doing the same thing. We were the earliest investor in Flex. We helped incubate them, and they did their Series D last year. We brought a strategic in. They were wildly oversubscribed. They asked us if we would sell a tiny piece. We sold a very small part of our seed basis, also for a 22x multiple in 4.5 years. So what we're going for, obviously, are the grand slams. But at a portfolio level, it likely goes somewhere between a 2.5 and 4, because you're blending the returns of all these different initiatives. And so and especially for the real estate owners and operators, they look at it as a double alpha situation. We have folks that say, hey, I'm investing with you because not just because we're hoping to make a return, but because we want to get industry knowledge and understanding, which we have these quarterly and sometimes monthly calls with our limited partners where we go through what we're seeing and what they should be looking at, maybe what they shouldn't be wasting their time on, trying to separate out all the noise. And that's great. But again, for us, the carried interest is how we make our money. So we have to ensure that we're balancing that well.
I love it. That was a great insight, knowledge gained by those investors in a different way. So often we hear, your strength can be your greatest weakness, greatest strength. And I think about the real estate space and the antiquated nature of the operators. And I'm curious how you underwrote that reality that it's a slow moving asset class. People want to do it what they've always done, like your grandfather did. And how did you underwrite getting them to adopt to this technology and to show them tangible efficiency and outcomes that would benefit them in the long run?
So I've got a few answers to that question. This is also one of my favorites. So first of all, now when we are pitching people and we're talking to them about our funds, the first thing I say to them is, I actually don't care if you invest with us or not. What I'd love is a relationship with your ops team so that we can use your real estate to help our portfolio companies. Immediately people say, well, wait a second, what do I get out of that aside from better operations? And then they say, okay, well, maybe we'll put in a small ticket. That's what ultimately ends up happening because it's double alpha. I'm perfectly happy for anybody that owns a nice sizable multifamily or commercial office portfolio to say, hey, Jeff, we want to be in your network. We want to see the latest and greatest. Fantastic. I will do it. I'll happily spend the time because it inures to our benefit as much as it inures to theirs. Ultimately, and we have a pretty high hit rate with this, people end up coming in because they say, well, wait a second, that's going to do well. I want that double alpha. But to your point about the antiquated nature, so I call this the dirty little secret. The first thing I tell people is take a deep breath. The reason why the real estate industry is seen as antiquated is that it doesn't need to iterate and evolve in the same way other industries do. It's a dinosaur not because of the actors. these are pretty sophisticated people. I would imagine you have a pretty sophisticated organization. It's the fact that you made a lot of money doing things exactly the way you've done it. We talked about my family earlier. They don't really assimilate too much technology any more than they have to because they're doing really well. That's the secret. It's when you're thinking about implementing and assimilating technology into your organization and dealing with the change management, both from a technological and human perspective, you have to measure that against what the expected ROI is. And if the ROI, I'm going to use an arbitrary number, if it isn't a 10x multiple, well, then why do you care? That's the secret, which goes back to why we've only done 50 deals in 15 years. Because most of these companies, you know what a Rube Goldberg is?
Yes.
They're creating this overcomplicated mechanism for solving something simple that, even if it's done manually, might be the most efficient way for that as a function of the dollars you're spending to get it done. This is the most important insight I can give. And so when we onboard new investors, when we onboard new LPs that own and operate real estate, we say to them, take a deep breath. You're doing fine. You're doing fine. Let's just show you what's out there. Because like some folks, I'll use one name because he's pretty public about it. So Empire State Realty Trust is one of our investors. Tony Malkin, chairman and CEO, he loves technology. He wants to see it all. And his organization is incredibly forward thinking in the best way about piloting new tech because of what he gets to do and say about that. He's willing to take that risk. There are other folks that say, whoa, slow your roll. We don't want to use this until it's been baked for years and we know that this isn't going to cause any operational disruption. So again, like this idea of the antiquated industry, I don't know, it's done pretty well.
Yeah. So it's all, you almost view it as it was an opportunity for you to bring them along in varying ways, be it as investor or as user, and just help them understand how they can improve their operating business. So that kind of prompts a thought about AI. So when you started this business, what year did Camber Creek start?
I would say informally 08, but formally 2010, 2011.
Okay, so forms of AI, machine learning, were certainly in place. But now, the media and the exponential growth of that and what AI can become and is becoming is changed dramatically. So I assume this has been really of benefit. It's been of benefit primarily to you, and it's going to probably present you with more investment opportunities. But is it also making some of your prior investments null and void because there's something better that's come along that can replace it?
Great question. Let me answer your last question first. This is an important one. The best companies in our portfolio, which I would say, if you disregard profitability for a moment, 80% of our companies are actually really strong as far as the utility that they provide for their end user. That number shrinks when you talk about the actual cash flow, potential cash flow and potential return expectation. But let's talk about operations for a moment. The best 80% are not getting disrupted by AI. They're evolving into AI. And let's be clear about what AI is. AI is not this monolith that came along and ate software. It is the evolution of the development of software. And so the most adroit companies had a strategy about how to, you'll hear them say replatforming, how they replatform their base such that the evolution of their company should follow the evolution of AI. Now, of course, there are external dangers with that, which is probably too deeply into the weeds for the purposes of this conversation. But for your audience, when they're trying to think about their AI strategy, what they should be thinking about is, hey, we have X number of people doing Y functions in Z amount of time. What software, what opportunities exist to truncate that effort and timetable? And that's where they should be spending time. So as an example, and you'll continue to hear this, but at first it was generative AI that people were really excited about. Let's use leases for a moment, saying like, oh, we're going to have an LLM do a lease. That ain't happening. Well, now the next iteration is agentic AI, essentially these autonomous agents that are running different functions within the business. They can act as an attorney and negotiate a purchase and sale agreement or negotiate a lease. That's not quite happening yet. What is happening is these programs are learning about your organization in a, let's call it, they call it an instance, in a siloed way, such that then you can use the repetitive learning to get to arrive to an answer for whatever query you have much faster. The net effect of this will be that organizations will shrink, right? You won't need as many people doing as many tasks. There's certain things like the manual labor, until robotics becomes ubiquitous, you're still going to have the same amount of superintendents probably that have to do physical things. But like one of our portfolio companies is called HappyCo. It's a Southern California based company. And they're a maintenance company. They have something called Joy AI. What they've allowed property owners and managers to do is say, hey, if you used to have one super for 100 units, we've actually been able to use AI to help you make that ratio 1 to 170. So again, pulling back up, the opportunity is figuring out how to do how to operate your business units in a more effective way, utilizing the software that legacy companies, like some of our older companies, 5, 6, 7 years old, again, not being disrupted, they're evolving. And the new companies that are being built around it, that's where the big question mark is, because you can, as an investor, we say to ourselves, well, hey, this does one vertical's worth of work. Well, what is the venture return opportunity when building that program is actually, the barrier to entry is getting lower and lower and lower? That's really what, as investors, what keeps us up at night. The legacy companies are actually a comfort in that arena because they already have the customer base.
Oh my gosh, I'm going to have you come back and do this again, because I have so many add-on questions from this. But what I thematically heard is replatforming, non-disruptive, evolution. AI can expedite, enhance that, and it was envisioned in your underwriting, if you will, that would be a reality of these investments.
Absolutely.
So I want to make sure, are you the sole owner of a company when you invest in them, or you're just a part and parcel, and then it gets into control and all those good things of those and the influence you can bring to bear with your smarts and experience?
Great question. So we take minority positions in fast-growing companies. So we're typically at the earliest stage, we might be the only investor, but we're still a minority position. So the owners the founders are trying to solve for, let's call it 20 to 30% dilution. So they would end up owning 70%. We'd own anywhere between 20 and 30%. But this is also a network game, and who you invest alongside with is crucial. And I'll put an even finer point on it. The disruption in the venture markets in 2022 were incredibly helpful to us, because prior to that, especially in 2020 and 2021, when you had this torrid pace of investment in the real estate technology sphere with valuations getting written up to absurd levels, part of the challenge was the actors that were involved in the space. You had corporate real estate offices thinking, oh, I can play venture capitalist too. Doing this, they got burned. Most of those folks are out of the game now. You had crossover funds that were investing at a ludicrously fast pace that are also less active now. Whereas the pros, and we would label ourselves the pros because we took years. We were real estate developers, my cousin and I. We took years to develop the venture capital muscle. Now we have that. And we have a decade plus of external operating capacity that has informed our investment thesis. And there are other groups in our industry that are professional. And there's a reason why, like, the best companies are getting funded by the best VCs and vice versa. So you don't have all of these actors that really shouldn't be participating in this in this investment industry. And so going back to the cap table, when companies are looking for funding, and I take a look and I say, oh, well, this isn't a VC, this isn't a, they have no idea what they're doing. They don't understand the governance aspects. They don't understand what the follow-on needs are going to be. They don't really know how to structure. You really want to make sure that you have smart money with you. And so for us, we like to be collaborative. So it's not always just us on the cap table. We like to invite people. And one of our largest deals, we went public with this last year, or sorry, I can't even keep track. Yeah, I think late last year, we invested in a company called Serhant, and that deal took me 2 years to put together. We led the deal, and then we invited another very large VC that is not in the real estate technology sphere, Left Lane. We've done a number of deals with them, to come in with us because they had expertise that we didn't. We play very nicely with people that have the same and similar goals to us.
Jeff, I want to be clear for our listenership. You are investing in what round of a typical company? And are you always, when you invest, do you intend that you're going to be in future rounds and save powder within the fund?
Yes. So we have a very large reserved follow-on ratio. We like to say, when people ask us this question, that we're Series A focused, which is early stage. But the fact of the matter is that, like, orthodox adherence to specific venture nomenclature and round nomenclature is not really our thing. We invest where there's opportunity. So we'll invest at pre-seed and seed. We'll invest at Series C and Series D. It's a function of how much value can we get for the dollars we're putting in and the effort that we're going to have to expend. That's the equation.
So I'd love to ask entrepreneurs and fund managers of sorts, what has most surprised you to the positive and the negative about this journey you started? I think you said in 2008. 2008 was that when you started?
Yeah, that was the informal, but the formal was 2010, 2011.
Got it. So what surprised you most? You had no idea was coming your way, for both the positive and the negative.
The arrogance, the unearned arrogance of some of the people in the investment community is staggering to me. I come from a background where there was no outside capital used. My family uses their own. Raising money is about the scariest thing that I do, because when you do that, it's essentially a promissory note with limited liability, but it's a promissory note that you're going to deliver results. And so when I'm raising a fund, I actually really despise fundraising. So we're actually hiring a head of IR right now because I don't like it. We're good at it, but I really don't like it, because I don't like the feeling it gives me until we make our first deal. And then it's like, okay, I know we're really good at this. And this confidence, it's also surprising that, I'm 46 years old. I've been doing this for a long time. That fear, which I think is healthy, is good. But there's so many people in our industry that have gotten rich off of management fees, and they have this ridiculous arrogance. I'm like, wait a minute, but what have you actually done? What have you built? And on the flip side, a lot of founders that we've met, that, you ever see the show Silicon Valley?
Yeah.
They remind me of the Trace Comas guy, like some of these founders. And I just think to myself, gosh, I just want to invest in killers that are focused and driven, not somebody who embodies the worst of what the industry is. That was the big surprise for me, frankly, unfortunately.
Well, very helpful. And I want to move us along here. And as I'm thinking about Camber Creek, first of all, where did Camber Creek come from? What the name is?
So the name, I came up with the name, although if my cousin's wife hears this, she's going to be furious because she thinks she did. But I actually have the emails to prove it. Sorry, Emily. It came, Casey's a big skier. We all ski, but he's a very good one, and skis had camber. And the idea of camber is that you have like this transfer of energy. And so we had this thought of like your potential, our energy, and it's like we create a burst together, a burst of activity. She may have come up with the Creek side. I can't remember that, like, because there was a Camber Capital, and so we said, I don't know how we arrived at Camber Creek. I have to look at the email, but that's where that comes from.
I like it. Yep. I was talking to the guy about how he came up with the name Montage. Great guy, Alan Firstman, who started it and is doing amazing. And he talked about, he hired some company and they wanted a bunch of money to come up with a name. And he just started looking through books and reading things and found this name. And it's so I'm always intrigued by how people arrive at their branding of their company. But I love it from, I'm a skier. You think about balance, stability, turning, pivoting, all the things that come off of the proper camber utilization.
Exactly. That's exactly what it was, because when we started doing this, we called it internally Berman Venture Capital. We never had the really the motivation to raise outside capital. And then we realized our biggest insight, going back to the founding story, was that our family is hyper insular. Technology requires a network to create virality, which creates a venture return opportunity. So we said to ourselves, we need to be outside of this organization and attract people that look and feel like us. And in order to do that, that's when we made the decision to start recruiting outside investors. And so we had to change the name from Berman Venture Capital to something else. And I have the whole email strand. It's actually really funny, some of the names we came up with that we didn't use. But Montage, Montage has that property in Laguna, obviously, that I can't imagine it being named anything else. It's such a beautiful Montage. That hotel is ridiculous. It's so beautiful.
It's quite something. Well, so Camber Creek's next chapter is going to be, and I want you to speak a little bit to the opportunity set as you look forward.
Yes, absolutely. So when people ask me to describe Camber Creek, I used to describe it as a venture capital firm that invests in real estate technology. Today, I would describe it as a private equity firm. And the reason is that we have two verticals now. We have our venture capital vertical. We also have a real estate vertical where we invest in brick and mortar assets where yield can be accelerated by utilizing technology. And so we're well on our way raising our first fund in that. And the idea came actually many years ago. Everything we do is quite deliberate and thought out. When we were noticing that our companies were adding measurable yield acceleration to owners and operators of real estate, we said, maybe we should own real estate ourselves, going back to our roots. So we call that initiative Origin, because that's our origins. And so in the future, I imagine that Camber Creek will have multiple venture capital funds, multiple real estate funds that operate in various sectors. But again, we take our time. We ensure that we're not getting distracted by any new initiatives that we do, and making sure that we manage our house well.
You and I share Provenio Capital as both an investor. I'm on their advisory board. They introduced me to you, and I will certainly thank them for that, because you provide a lot of good insight. So as we look to wrap up here, being mindful of your time, and thank you for that, I'm kind of curious a little bit about your favorite aspect of the job. I think I know what isn't your favorite aspect of the job, and that's the money raising, but you're obviously quite good at it, and that's gotten you to the dance, and now it gives you options going forward. But what's your favorite aspect of the job?
It's building with smart people. My particular specialty is the really early stage, helping incubate companies. Like I said, Flex, we helped incubate them in 2018, 19. It's now a multi-billion-dollar company. It's one of the biggest it's one of the biggest fintechs you've never heard of on the planet. On purpose, the founders are actually really special people that have stayed very much under the radar. Getflex.com. It's worth checking them out. But getting to build with Shragi and Shao, and with Ryan Serhan at Serhan, and with Rachel Chern at Verify, and with Karen Mayo at 100, this is what gives me energy. It is so enjoyable to work with really intelligent people and solve big problems and build big companies. I can't get enough of it.
And I'm assuming that these people that you give your capital to from your funds, while capital is fungible and there's a lot of that out there, they are very intrigued and interested in having you invest with them because of the other things that you can bring to bear in advising them and showing them your own experiences and helping enhance that investment that you give them.
That's spot on, and that's why we typically get better valuations than our competitors, because oftentimes we're investing in incredibly hot companies and we're the lowest or second lowest term sheet, and we say, look, we have to deliver value for our investors in two ways, and this is one of the ways that we do it. And if you see the value in having us on the cap table, then we're going to be worth the delta between the valuation you're taking now and what you're going to be worth in the future. And it's worked.
Jeff, as we wrap up here, I know you mentioned that we might be interrupted on this pod that we were doing together by your kids coming in. So far, so good. But as you think about young people and our industry and mentorship and passing on and paying it forward, what words of wisdom might you offer a young person listening on this today that's getting ready to start their career or in their career, and as they think about their future, what have you learned on the road trip that would be valuable?
You ever see Rocky IV?
Probably. I can't recall it specifically.
There's a montage there where there's a song played that is probably the best lesson you can learn. It's called No Easy Way Out. And it's the truth. There is no easy way out. There's no substitute for putting in the work. You want to play this game? Show up prepared. Period. Full stop.
Right. So I think when I started in the business, you could be a generalist. I think today it's really important that you develop some expertise and a specialty and then maybe move from there different, because our industry today is much more of a commoditized industry with options out there. So I think having that expertise, showing up is great advice. Well, I want to thank you for your time today. This has been fun. I learned not to refer to your asset class as prop tech, but real estate kind of technology.
No, just us. Everyone else you can call prop tech.
Yeah, exactly. Well, I'm sure interested a lot of our listenership to looking you up and thinking about investing with you. And certainly, as they inquire, I will help you out in that regard. That was not our intention today. I think about replatforming, developing venture capital muscle. The promissory note with limited liability. A lot of takeaways for me, and I'm sure our listenership, and we'll welcome you back. So I hope you take me up on that, and please enjoy the wine I send, and let's have a follow-on conversation. I'd like to learn a little bit more about your wine passions and expertises. I assume you're a red guy primarily?
I'm a red, white, and everything in between. I do not discriminate. My palate is discriminating, but I do not.
I understand. Well, thank you so much for your time. Look forward to officially meeting you. But I want to thank everybody for participating on our Accounting Capital podcast. Jeff did not disappoint, as I'm sure there was evidence, and we will have him back because I've got a lot more questions and curiosity that he's prompted me to think about. So with that, thank you for joining our version, and we'll see you on the next Accounting Capital podcast.
Thank you for joining us on this episode of the Accounting Capital Podcast. For informational purposes only and not to be relied on in any manner as legal, business, financial, tax, or investment advice. Nothing in this episode is an offer to sell or the solicitation of an offer to buy securities. To learn more about Buchanan Street Partners, please visit our website at buchananstreet.com. Buchanan Street Partners, capital you can count on.